Wondering how ETFs can fit into your portfolio? Join us for our Spring into ETF Investing event, premiering May 24th and 31st. Check out these two exciting two-part events, which we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide you with the information and education you need to confidently manage your own portfolios. You won't want to miss these specials. Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen, VP of Online Distribution with BMO ETFs. And today I'm joined by Larry Berman from ETF Capital Management. And I and many in the industry consider Larry a pioneer in investment management. He was one of the first to really adopt an ETF-focused approach in his tactical portfolios, really seeing the value and efficiency of this vehicle. And we'll be getting his thoughts on the market and some ETFs he's using in his portfolios today. But before we get started, a quick reminder that we're not providing any investment advice or recommendations. This channel and this video is all about providing education around investing and around using ETFs for Canadian do-it-yourself investors. So Larry, welcome back to the show.
Hi, Erin. Great to be here.
Thanks for coming. So Larry has nearly 4 decades of experience, and he appears weekly on his BNN show, Berman's Call, which you have probably heard of, where Canadians can actually call in and ask him any questions around the market, stocks, ETFs, which has led it to become one of the #1 shows on BNN. Larry also has his own YouTube channel where he does weekly updates and takes questions from investors, so you can check that out after this video. But his tactical approach to investment management, along with his expertise in technical analysis, really sets him apart. Always leads to a very engaging discussion around the market. So Larry, let's jump right into it. We're ending off earnings season in the US, and I'd love to get your review in terms of what we saw across the board.
Yeah, I just simply look at what people are doing in the industry and aggregating up the numbers. And, FactSet does this and Bloomberg does this, Bloomberg Intelligence. And so I'm just going to quote some numbers from the aggregate. So in the S&P 500, as of when we're speaking right now, a little over 400 companies have reported. So about 80% into earnings season. And when we started earnings season, the expectation was for somewhere around 3.8% earnings growth overall for the index for the quarter. The first week, that came in really under, but it was related to one specific company which had a very large one-time item. When we look at it now, the run rate is 6.5%. So this earnings period is really, really good, but it's very bifurcated. And so what do I mean by that? Well, out of the 6.5%, if you take the weighting and you can back out certain sectors. And so if you say 6.5 overall, but if you say X technology, it's 2.9, right? If you take value versus growth, so take the growthier names in the S&P 500, those earnings sequentially up 42%. Great, wow. If you take the value names, down 4.5. So you're not getting a broad market rally. Early in the year, for sure, it was narrowly led by the Mag 7 stocks, formerly known as the FANG stocks, and some others that have joined that group.
Yeah, so if you strip out some of those different areas of the market, maybe not as strong, but overall looking good. So given what we've seen in earnings, we did have that recent pullback, I guess it was a week ago now. How can we explain that? And what are some of the key risks facing the markets today?
You know, I think a lot of this is tied into, cost of capital. What's interesting, Aaron, about this cycle that we have not seen historically, certainly in my career in the last almost 40 years, as you point out, um, the insertion of inflation pressures, the insertion of a world that's gone to less globalization, the incredible shock to the world supply chains from COVID. A lot of that is been adjusted, but you had a world where always production went to the cheapest place to produce a product. And now with this onshoring and reshoring, just in time inventories are becoming just in case inventories. And so when you're building something domestically, it costs a little bit more than if you were building that product in the lowest cost of production. So you've got a lot more things that have entered the world economy that are a bit more inflationary, a bit less productive from that perspective. But you've got some offsets too. One of the offsets, of course, the next, real big thing, artificial intelligence, right? So that's going to add a lot of productivity. We're very early in the game. Like we've seen zero in terms of real productivity gains from a global economic perspective with AI. There's a lot of excitement about it, but we really haven't experienced it in a meaningful way at the moment.
Yeah, people are kind of fumbling with it and figuring out how to use it so far.
Yeah. So again, a big part of it, we have an interesting chart here to show if we can bring it up. And what we're looking at here is basically the outstanding total debt of the U.S. government. So that's that big red line going up there. If you project that out 3 years, 5 years, 10 years, it just gets worse and worse and worse. So the amount of money governments had to spend post great financial crisis, you could see that red line kind of takes a little bit of a hockey stick turn post GFC. And in the era of zero interest rates, there was a lot of ramp up of debt, and the cost of that debt, if you look at one of the blue lines there, you can see that that is basically the yield to maturity of the entire universe of debt. And so as it came down, they spent more and more and more. But now you've got this massive debt, and the cost of debt now is going up. So that's created a massive headwind to growth by way of massive deficits, which makes the debt problem worse and so forth. So our cost of capital has gone up like nothing we've seen in the past, say, 15 years in financial markets. And that really hasn't passed through yet to margins and earnings. And so when interest rates get pushed up, as we've seen in 2024 so far, that has been behind some of the corrective price action we've seen. Now, at the recent FOMC meeting and what we got from Janet Yellen in terms of funding of the next tranche of Treasury debt, she's choosing to do that more with bills and less coupons, and that has an impact on financial markets. So we've snapped back a little bit. The Fed, there was talked about that maybe they need to hike rates more. They walked that back, and so we've got this new period of relief coming. But what hasn't changed and isn't going to change is that purple line, which is the coupon, and that coupon, as bonds reset and new issues come, the cost of that debt is going to go up and up and up and up. And the debt overall is going to go up and up and up and up. And that is not going to change as far out as you want to look unless governments come together and get fiscally prudent, which I don't care who wins the next U.S. election, just not going to happen.
More taxes in our future. Okay.
More taxes in our future, again, headwind to growth.
Okay. Well, let's look at valuations currently and your thoughts there.
Yeah, so here's an interesting dynamic because when you go back and look at the 1970s and the inflation there and what was the big part of the S&P 500, energy companies were actually a big part of the S&P 500. Much like the TSX, energy was a big part of it. Less so in recent years. And so when you look at the makeup of an index, today technology is 29% of the S&P 500. And you would argue successfully that they don't have a big cost of capital typically. They don't tend to use a lot of debt. An Apple, a Microsoft, think about how much outstanding debt they have. It's not a whole lot. So their financial ratios are good. They're not impacted by the rising cost of debt, and they throw off a tremendous free cash flow. So you could argue that the multiple on these growth companies should be higher. And so the bigger component of the market that's technology, where the old multiple fair value might be thought of as 15, 16, or 17, you could probably successfully argue that the fair multiple with technology leading and likely to lead for a couple of decades, that the multiple might be 18 or 19 now, but we're still trading at 21. So it's a little bit expensive, but it's not a lot expensive. I don't think we're going to go back to 15 being fair value or 16 being fair value, given the makeup of the index.
Okay. And talk to us a bit, you did mention interest rate policy, but maybe a bit about Canada versus the US and inflation as we stand today and what we can expect.
Yeah, I mean, you look at what's the leadership sectors coming in the world. Aging demographics, healthcare. What do we have in healthcare in Canada? We have a bunch of weed stocks, right? So when you look at biotechs, where are they listed? Europe and in the U.S. When you look at financial services, great, we got a lot of that. So Canada has that benefit, but it's so big a part of the TSX. But when you think about technology, we don't have a whole lot here. We have a few really good companies, but you get no diversification investing in Canadian technology as a general rule. So where do you get that? You get that in the US mostly. So when we look around the world as where's the consumer stocks coming from? Where's the economic growth coming from in the world? It's not Canada. And so I increasingly think globally in our portfolios. I was at a presentation a few weeks ago. John Graham, who's head of CPPIB. There's pressure coming from the Trudeau government to Canada Pension to invest more in Canada. And so you got the government saying, hey, invest more here. And our investable universe of where the growth is coming from Canadians. So that's a real conflict of interest to me. And so when I think about portfolios, you want to get rid of that conflict, and you want to think about when a client gives me $1, where can I put it to best get them the best return? And if I think with handcuffs on, meaning I'm forced to buy Canada, Canadians won't have as good a return in their portfolio if you think that way.
We've certainly seen a ton of flows going into ZSP, and I'd say on the Canadian side, people are really looking at ZLB, the low volatility option in their portfolios for that exposure.
It is. I mean, it's a great way to get exposure to equities, some growth, but with a little bit less risk, right? So, low beta or lower volatility, you can build a great diversified portfolio, which ZLB has proven to be for the better part of a decade now. In getting robust exposure, not heavily concentrated in technology, and not that that's a bad thing, but it's just a different type of exposure.
Yeah, complements that U.S. exposure nicely. When markets are uncertain, you often turn to option strategies in your portfolios. So walk us through, in terms of ETFs for Canadian investors, some effective strategies that they can use during these uncertain times.
Yeah, I mean, traditionally, you would think about getting balance for an investor. When an investor does their risk tolerance questionnaire, whether they're working with an advisor or even if they're at a discount broker, when you open an account, they ask you about your risk tolerance. And so, most people fall into what would be called a balance category, where if you're taking full on risk, your standard deviation in your portfolio, all equities, historically would be around 16, 17%. So if the long run rate of return for equities is around 8 or 9, maybe 10 in the US, and you have a standard deviation on average of around 16 or 17, you could have years in like 1 year in 4 where you're down 25%, right? And a lot of people can't handle that. So that's where the balance comes from. But with interest rates having come down over decades, and when they got to negative in places in the world and extremely low rates in North America during COVID, we shifted our way that we protect for clients to using more option protection. The only real negative beta today with the inflation pressures in the world, and to protect portfolio, is a put against the exposure to equities, right? So BMO came out with a series of ETFs earlier this year. I've been implementing these strategies in the funds that I run for BMO for almost 4 years now. And it's the use of options to lower volatility and protect. So imagine that you get the potential for all equity returns, so very tax efficient, coming from capital gains generally, but you get the balance that you need from a volatility perspective. And if you look at a 50-50 or 60-40 portfolio, bonds to stocks, and then you compare it to ZGen, you can see how it smooths out the volatility for you compared to all equities versus all bonds. And so these ETFs are a bit more tax efficient because there's no income coming off the portfolio from your bond holdings. So in a taxable account, they're far more tax efficient. And so I like these as alternative ways of getting exposure to equity markets in a balanced way for investors. And again, we do a lot of this in ZZZD, which is the sleep at night dividend ETF that, I'm trying to get a nice dividend with a lot less volatility, and where, dividends are shining in the world, we can expect some good growth there. For the last couple of years, dividend exposure has underperformed, largely because technology has been leading the world for a few years. Yeah.
Well, we talked about buffer ETFs a bit on last week's episode, but going back to my original point about you being a pioneer in the industry, is a lot of these ideas have come from things that you're doing in your portfolio. When we had you at our ETF Investor Day back in February, you talked a bit about ZPay, and we saw a lot of questions following that. Do you still like ZPay in your portfolio today?
It's still in our ZZZD. It's a big exposure. I really love the principle of it. Buy low. So markets sell off, you're writing puts. You get to buy the stocks you want to own at a lower price. And if the markets don't go down, you get the income from that. And you already own the stocks you want to own, but you have with a covered call, so you get extra income from that. When you look at exposure to the S&P 500, right now, the dividend yield is about 1.7, 1.8%, somewhere in that range. Actually, with markets at near all-time highs now, maybe it's a little bit less than that. So you're getting 3 to 4 times the income. It's tax efficient because the tax treatment on optionality is capital gain for the portfolio. So it's a tax efficient income from a foreign source, which is great. Markets go down, you buy more low. Markets go up, you sell high. And on average, you have about 50 or 60% of the volatility in your portfolio. So for the income seekers out there who want income as a higher percentage of their returns month to month, this is just a fantastic solution for them. And so it remains one of my favorite strategies today.
Okay, sorry to get you off track there. So we were talking about how 60-40, bonds are going to struggle with yield, with the correlation with equities going forward. So let's talk a bit more about alternatives here. We did talk about buffers, but what other alts do you feel can be effective?
Well, I think, again, I'll go back to John Graham. And while I don't expect anytime soon that we're going to see private credit or private equity ETFs, there are a couple in the US, but you're not actually investing in private equity or private credit. You're investing in the public companies that have those funds. So it's slightly different. But I think one of the reasons Canada Pension Plan is the top sovereign wealth fund in the world over the last decade is they have a huge exposure to private investments. And so alternatives using options, alternatives using private investments, I think are very important part of an overall portfolio construction. And so, I'll challenge everybody in the ETF world to come up with a solution, in privates. And it's a big challenge because one of the benefits of privates is you earn a liquidity premium. And so you don't have the liquidity of the day-to-day ins and outs that you would like to have as an ETF investor. So that's an investment problem that's probably not easily solved, but I imagine someone will solve that. Well, maybe not in the days, but certainly in the months and years ahead. So I would look forward to that. But I think alternatives, ways of minimizing taxes and lowering volatility in your portfolio are going to be a big part of it. Years ago, and this was around Brexit, where we were running a traditional balance fund for clients at my firm, ETF Capital Management. We converted that to what we called a real asset and infrastructure balance fund. So there was more emphasis on REITs and infrastructure where those companies have a much higher component of income. So you have a much more stable, they're much less cyclical. And so while there are cyclical aspects to it, they have less volatility, generally speaking, than a tech stock or a consumer stock. So I like real assets and infrastructure as well in terms of exposure. Things that are uncorrelated may make sense in portfolios, like gold, for example, right? So when you're considering portfolio construction and putting the different pieces together, gold could be part of that. Now, recently this year, gold's had a pretty good run. Is it going to continue to go up? I don't know is the answer. I think so, but I don't know is the answer given the fiscal challenges in the world and some of the inflationary challenges in the world that I think are going to be with us for a little while. Gold might make sense, but maybe it should be in gold equities, right? Gold equities right now are about the cheapest they've ever been historically to the price of gold.
Yeah. Okay.
And there's an ETF for that.
I was going to say, if you preferred gold companies or gold bullion, we've got both of those at BMO. So options for everybody for sure. And hedged, unhedged, US dollar. So much flexibility in the ETF space now to really create the portfolio you want. All right. Well, thank you so much for your time, Larry. Very insightful discussion. I always enjoy your views on the market. So thanks for joining us, and I look forward to having you back again soon.
Yeah, my pleasure. And take care.
Next week, we have a long weekend. So as always, we'll be taking a break from the show. But stay tuned for Spring into ETFs the following weeks, where we have two exciting two-part episodes airing. You can check out etfmarketinsights.com for all the details around those episodes. But that's all for today. We'll see you next time. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.